In this video, we're going to take a look at the pace of tape gauges and in particular how they can be used in the wild and volatile markets we're experiencing right now. For those who watch this video in the future, the backdrop to this is that we're at the start of what appears to be a US versus China trade war. So the US index futures have become really volatile. The correlation between the Dow, the Nasdaq and the S&P is breaking down continuously through the day, and the S&P itself is swinging wildly, making it tough to stay with the trade. So despite the fact the gauge is new, it's still an order flow tool. So the same basic concepts are in play, and those are: one, how active are the market participants? What are they doing? And two, how is the market reacting to that activity? So in this volatile market we're at now, there are times when the correlated markets do line up again. So what we're going to be looking at is a few things here. So first of all, we're looking for the market to appear to be correlated, right? So we're looking for a time when the Dow, the Nasdaq and the S&P do seem to line up. We're looking for the market to appear to be putting in a weak counter move. And for confirmation of that counter move is pretty much over in the Dow, Nasdaq and S&P. What I want you to do here is keep an eye on the pace of tape meters and keep an eye on the Nasdaq and the Dow. Nasdaq and the Dow are both breaking down now. You can see the pace of tape is about average. And then we pull back. Still an average amount of trade, but the pullback doesn't really look to have any legs on it. If you look at the Dow and the Nasdaq and the S&P, there's no real move up there. So we're expecting another push down. Now what's interesting is, again, watch the Nasdaq and watch the pace of tape. And what we're looking for specifically on the pace of tape is for all three markets to redline. So what happens is we push down, and as you push down, there's people watching this and they think they are missing out on the move down. So as we push down, you get more and more and more participation, right? So we can see again, the markets are starting to redline. We've got all three markets pushing down, right? We've got red line on the S&P and on the Dow. We've got red line on the Nasdaq. Look at this big push down on the Nasdaq. All markets hitting the red line, hitting the maximum. And then we see a little bit of green on the S&P. We're going to see the Nasdaq start to tick up a little bit. And we've got some absorption. So we know the bidders, we can see the depth here, the bidders stepped up a little bit here. And now you've got the Nasdaq popping up. So effectively what's happened there is as we push down, people got excited, people thought they were missing out, and more people got into that move down, and that's where they got stuck. So very much like the volume spikes we've talked about before. This one's going to be a little bit faster now. Just to reiterate, this is not a how to trade video. This is really just about that fear of missing out and the process of exhaustion and how to see that on the meters. What we're going to see, we'll see the Nasdaq and the Dow turn down. The meters, as the Dow and the Nasdaq move up, are quite weak. Then they start to roll over. S&P starts to tick down. And then we start to gradually move down a little bit more. And again, we're going to see that high readings on the meter. You see a lot more activity and the market stops again. So let's watch that play out. Now we know what to look for. So this is the week move up. If you look at the size going through there per level, 90, 63, 50, not much on the way up. Then the market rolls over. We can see the Nasdaq going down. Now the Dow going down. Start to see some red on the S&P. We can see below at 26.45 an area of high liquidity. Let's just watch the gauges. Watch how the gauges. Over to the right, we're pushing down, and everything redlines. As they redline, we can see this area of absorption here, 26.45. We've got some sellers stuck there, but you can see basically they're really pushing this hard. There's really a lot of trades coming into the market, and the market stopped reacting, and now we can see the market popping back up. So it's a change in pace that we're seeing, a change in behavior in the market that the meters are showing us. It's probably the opposite to what you'd expect. You'd probably expect that when a huge amount of trade comes into the market that it would actually run faster. But in a lot of the times, it appears to be that the market makers actually step up when more traders come into the market. And again, one explanation for that is the traders are coming in because they fear losing out. and the market makers know that they're weak hands coming in at the end. So let's have a look at one more example, this time over on crude. Here we have crude moving down at a moderate pace. We can see that we've been having progressively lower highs, so expectation is that this market's going to push down. Look at the meter now. We've now got that excess in amount of trade, and we get that excess in amount of trade, and what happens? The market stops moving down once more. Now what I'll do, I'll just fast forward this, and what you can see is that after that point where we pushed down, we got some absorption, and now the market's moving sideways, and indeed in the end the market did start to push up again, which I guess is not surprising if you consider the fact that even though we're putting in lower highs, we're also putting in higher lows, which means the market looks like it's starting to consolidate. So the takeaway from this video is to keep your eye out for excess trade. It is still useful to look at the meters on pullbacks for a lack of trading activity. It is very useful, but also when the market gets underway, look for those excesses in trade. And when you start seeing excess in trade and the market can't move forward anymore, then it's just a warning sign that that move might be open. Anyway, we'll put out more videos on the pot meters, more examples. I wanted to get this video out today because a lot of people have been struggling with the additional volatility on the S&P, and the market has been pretty wild. So I wanted to just get this out there so that if you're using the S&P and you're not using the meters at the moment, to just bring them in and have a look at them, and especially when you get these wild swings, to just keep your eye on the meters and see what happens when those swings end. So anyway, I will see you in the next video, and thanks for watching.